Oracle just closed the books on fiscal Q4 2026, and the results are historic. Total revenue hit a record $19.2 billion, surging 21% year over year. Cloud is now the only growth engine that matters. Total cloud revenue reached $9.9 billion, up 47%. Breaking it down, Oracle Cloud Infrastructure, the raw AI compute powerhouse, exploded 93% to $5.8 billion. Cloud applications grew 10% to $4.1 billion. Meanwhile, on-premise software continued its 2% decline to $6.8 billion. That slide is secular, not cyclical. It won't reverse. Gross profit printed at $12.5 billion at a 65% margin, compressing 5 percentage points year over year as the heavy cost of AI infrastructure arrived on the income statement. Operating income, $6.1 billion at 32%. Net income, $4.3 billion at 22%. The number that crushed every estimate, non-GAAP EPS of $2.11 versus Wall Street's 1.96 consensus. A decisive beat. You are witnessing one of the most aggressive structural pivots in enterprise tech history. Track the 15-quarter evolution from fiscal 2023 to Q4 2026. The landscape has permanently flipped. Notice the reporting shift in fiscal 2026. Oracle completely restructured its metrics, cleanly isolating pure cloud revenue from legacy software to expose this exact transition. Legacy software, once Oracle's lifeblood, continues its secular decay, compressing to $6.8 billion. Meanwhile, total cloud services just surged to $9.9 billion. This is the definitive crossover moment. Cloud has officially eclipsed 50% of total revenue. Oracle has permanently shed its aging legacy image, reincarnating as a behemoth manipulating the world's AI compute grids. Oracle Q4 2026. This is the AI supercycle paradox on full display. Record growth colliding head-on with record spending. On the infrastructure side, the numbers are staggering. IaaS revenue surged 93%. GPU utilization hit a redline 97.5%. Virtually every chip Oracle owns is running at max capacity. The company has already deployed 1.2 gigawatts of power, enough to run a small city, and demand is still aggressively outpacing supply. The multi-cloud database strategy is paying off beyond expectations, driving a 531% expansion across 33 Azure regions, 14 Google Cloud regions, and 22 AWS regions. Oracle isn't competing with these clouds. It's embedded inside all of them. Pricing is also evolving, shifting from traditional server uptime billing to token-based AI consumption and outcome-based fees tied to real business results. The AI networking segment surged 404%, making it the company's fastest-growing business in history. The $823 million restructuring charge is the steep price of pivoting a workforce from legacy software maintenance to neural network architecture and energy supply chain management. Now, the paradox, $638 billion in contracted future revenue, up 363% year over year. Yet only 12% of that converts to cash within the next 12 months. Capital expenditures burned $56 billion, producing a negative free cash flow of $23.7 billion. The $75 billion in customer finance hardware is the vital structural relief valve keeping this model financially viable. The global cloud infrastructure market reached $129 billion in Q1 2026, growing 35% year over year. AWS leads at 28%, Azure holds 21%, and Google Cloud at 14%. Oracle sits at 4%. But here is what that single digit conceals. Over the last 4 years, while AWS bled share from 33% down to 28%, Oracle steadily doubled its footprint. Oracle is the only player outside the big three consistently gaining ground. They aren't doing it by fighting AWS for basic enterprise workloads. They're doing it through sheer AI brute force. By deploying a bare metal RDMA network architecture specifically optimized for massive GPU clusters, Oracle is structurally undercutting legacy hyperscalers on networking and compute costs, solidifying OCI as the premier computing factory for large language models. Oracle is advancing across 3 of the most lucrative SaaS verticals in enterprise tech, armed with a definitive moat: Fusion agentic applications. In human capital management, Oracle holds a 5.4% foothold in an arena expanding toward $53 billion by 2030. Their edge? Autonomous agents that actively recruit and calibrate talent, transforming HR into a dynamic system of outcomes. Pivot to enterprise resource planning, the absolute stickiest software in the corporate stack. Oracle commands a formidable 11.2% share, directly challenging SAP. Here, AI isn't just a passive co-pilot. These agents autonomously execute complex supply chain workflows and settle invoices, riding a market scaling to $123 billion. Finally, customer relationship management. Oracle's 4.1% secures a highly strategic beachhead by inextricably tying front-office sales pipelines to back-office ERP execution. They deliver an integration pure-play vendors simply cannot replicate. 3 massive markets, 3 compounding cash engines. In the global database management market, Oracle stands alone at the apex. Commanding a 21% share in a $132 billion industry, Oracle maintains a definitive lead over its closest rival, Microsoft at 17%, and holds more than double Amazon's footprint. The broader market is accelerating toward $460 billion by 2035 at a 13.3% CAGR. But Oracle's dominance isn't just a statistical lead, it's an unbreakable structural moat. Rather than forcing clients into a closed ecosystem, Oracle executed a brilliant open multi-cloud pivot by deploying Oracle Database at Azure, Google Cloud, and a newly launched AWS Interconnect. Oracle physically embeds its servers directly inside competitors' data centers. Furthermore, the new Oracle Database 26 AI unifies vector and relational data into a single engine, eliminating the complex integration tax for enterprise AI. Raw compute is a commodity, but high-value data has gravity. Oracle owns the gravity. Oracle's roadmap to 2030 carries one singular ambition: become the world's AI storage brain. The physical build-out is staggering. Total power capacity targeted, 5.5 gigawatts, roughly the output of 5 nuclear power plants. 1 gigawatt comes online by Q1 fiscal 2027 through rapid, liquid-cooled data center deployments. And fiscal 2027 capital expenditure is guided at a breathtaking $70 billion, the largest infrastructure investment program in Oracle's history, funding the next generation of multi-gigawatt super sites. Commercially, Oracle is pioneering a token-based AI ecosystem, an internal currency that lets customers pre-purchase flexible access to deep learning compute, vector databases, and integrated SaaS capabilities, eliminating rigid server contracts. Outcome-based pricing ties Oracle's fees to real business results, digitized records, automated payments, successful transactions, repositioning Oracle from a simple infrastructure vendor to a strategic business transformation partner. Financially, the bring-your-own-hardware model is a structural masterstroke. Customers act as de facto banks, funding $75 billion in hardware arrangements, allowing Oracle to deploy at massive scale while maintaining return on invested capital in the high 20% range. And at the center of the ecosystem, the $300 billion Stargate commitment with OpenAI, scaling from $30 billion in fiscal 2027 to $100 billion annually by fiscal 2031. Add AWS Interconnect and gigawatt-level energy leadership, and Oracle isn't just building a cloud. It's building the infrastructure backbone of artificial intelligence itself. Behind the scenes, Oracle's operating expense structure is being ruthlessly reshaped for the AI era. Research and development held largely steady near $2.6 billion per quarter. Oracle is betting its innovation budget on hardware deployment velocity, not internal software cycles. Sales and marketing actually declined to $2.1 billion. When AI compute demand wildly exceeds supply, you don't need to spend on advertising. Oracle is operating in a pure seller's market. The start Q4 outlier, an $800 million restructuring charge, up roughly 900% year over year. It reflects the brutal cost of pivoting a global workforce, pushing total operating expenses to $6.4 billion. Oracle's profitability track across the last 3 fiscal years tells a compelling story of durability under pressure. Alongside consistent top-line growth, net income followed a steady upward trajectory, climbing from $1.6 billion to $4.3 billion and keeping net income margins tightly in the 18 to 22% range. The single glaring anomaly was Q2 fiscal 2026, where margins surged to 38% due to a one-time $2.7 billion pre-tax gain from asset sales. Stripping this out, the core margin engine delivers a remarkably stable 20 to 22%, though facing increasing depreciation pressure as massive capital expenditures begin flowing through the income statement. For years, Oracle's beat and miss track record severely tested investor patience. From Q4 fiscal 2024 through Q3 fiscal 2025, they missed revenue estimates 3 out of 4 quarters. Those misses were modest, but they consistently damaged credibility. Today, that narrative is officially dead. Fueled by the AI supercycle, the momentum has completely flipped. Oracle beat the street in Q4 fiscal 2025, beat again in Q3 fiscal 2026, and just delivered another decisive victory. They printed a record $19.2 billion, surging 21% and clearing the consensus. Looking forward, management reaffirmed an aggressive $90 billion target for fiscal 2027. The demand is there. Execution is everything. The earnings per share story mirrors the revenue recovery, but with significantly more volatility. After suffering 4 consecutive non-GAAP EPS misses during fiscal 2025, Oracle finally strung together 3 straight beats. You have to strip out Q2's massive beat that was heavily distorted by one-time asset sales. But even adjusting for that noise, the underlying trend is highly disciplined. Q4 delivered a definitive victory, printing $2.11 against the $1.96 estimate, surging 24% year over year. Forward guidance is where the real tension lies. Oracle just raised its full-year fiscal 2027 EPS target to a bullish $8.05. Yet, the market is no longer looking at earnings. They are staring directly at the $55.7 billion in capital expenditures hitting the balance sheet. Now, the question that matters most: where does Oracle stand right now? Currently, Oracle trades near $184 per share, collapsing roughly 20% from its pre-earnings peak. Following the Q4 report, shares plunged up to 11.9% intraday in a brutal sell-off. The market wasn't reacting to the $638 billion backlog or the 93% IaaS growth. They were reacting to the footnotes: a staggering $55.7 billion in capital expenditures, negative free cash flow of $23.7 billion, and a shocking plan to raise $40 billion more in fiscal 2027. That includes a highly dilutive $20 billion equity program. Yet, Wall Street's conviction holds. Among 40-plus analysts covering the stock, 32 maintain strong buy ratings. The consensus price target sits at $256, implying a 39% upside. Guggenheim even reiterated its $400 target, urging investors to aggressively buy the dip. Oracle's bull thesis is ironclad: a $638 billion backlog and 97.5% GPU utilization. But the bear case is very real: extreme OpenAI counterparty concentration and $122 billion in long-term debt. Oracle's path to $1 trillion valuation is not in question. Only the pace and the price remain to be seen. As always, this analysis is for informational purposes only and does not constitute investment advice. Please consult a qualified financial professional before making any investment decisions. Thank you for watching. If this deep dive provided value, please hit like, subscribe, and share. It helps more investors access quality, data-driven research. See you in the next one.